Joining us with more on the bond market's response to S&P's downgrade is Ajay Rajadhyaksha, head of U.S. fixed income strategy at Barclays Capital, the second biggest underwriter of U.S. debt. He joins us now from his office here in New York. Ajay, welcome back to Bottom Line. Always a pleasure to have you on.
Good to be here.
Ajay, we were just receiving word the U.S. 10-year note yield falling to 2.32. That's the lowest since 2009.
Right.
Even with the downgrade and even what's going on with Treasuries as we see right now, still the best place to be at this time?
Oh, by far. Apparently a downgrade, a one-notch downgrade is worth 25 basis points nowadays, but in the wrong direction, from the direction S&P was pointing us in. This is just a massive, massive flight to quality that has been happening over the last week and a half. And it seems like Treasuries are still the best flight to quality asset out there, regardless of what a rating agency says.
Well, we see the Chinese, the largest holder of U.S. Treasury securities, chastised the United States for the downgrade, but Japan, the second largest holder of U.S. Treasury securities, expressed confidence in them.
Yes, so the Japanese, remember, went through something similar themselves where they were downgraded by the rating agencies. Their bond yields took it in stride, kept rallying, partly for economic reasons. So the whole advantage of having a rating is if you are looking at assets which are not well understood. That is not the case with U.S. Treasuries. That is not the case with the balance sheet of the United States. So the market makes up its own mind.
And when the market makes up its own mind, what's the prognosis?
The prognosis is that given the status of the dollar as a reserve currency, given the political and legal systems in the United States, given the fiscal condition of the United States, yes, there are warts, but right now the United States is still the best place to be, U.S. Treasuries, if you are trying to flee, if there is a flight from quality, which is very much what is happening right now.
And Ajay, as you know, the Treasury auctioned $29 billion in 3-month bills at 0.045%, and the bid to cover, that compares the bids received to the bills sold, was a 4.09 today. Is that indicative of any concern about that S&P downgrade?
No, not at all. I think right now, what you will see if you ask people in money market funds, for example, is that there is still a scramble for collateral. And by collateral, I mean bill collateral. So the world is taking this ratings downgrade in its stride, looking at it, realizing that it doesn't really change what they think of Treasuries and moving on.
And rejoining us, Ajay Rajadhyaksha, head of U.S. fixed income strategy at Barclays Capital, the second biggest underwriter of U.S. debt. Ajay, thanks for your patience. You just heard our Zara Burton telling us what's going on the floor of the New York Stock Exchange, the mood. Do today's numbers give you pause? Are you concerned?
I am concerned, but I'm not concerned about the U.S. downgrade. I'm concerned about the technicals that we see on the equity side, and I'm concerned about the mood coming out of Europe. But some of these moves tend to be driven by things that are not very logical. For example, one of the theories Zara mentioned as hearing is that banks are taking it on the chin today because they own a lot of treasuries. Well, guess what? Treasuries are up in price massively. So if that is the reason, then banks should all be up in their stock prices. This is just not logical, but you throw the baby out with the bathwater on days like this, and logic goes right out the window. And that's exactly what's happening.
Ajay, if I might ask you in our last minute, the Fed, the Open Market Committee, tomorrow's meeting, what are you expecting? Are you expecting more of that extended period language to come out?
We don't expect the Fed to do anything different because we think the Fed will take a little bit of a step back, say that the unemployment report was not great, but it wasn't the labor market falling out of bed any more than was expected. Make the case that stocks have fallen a lot, but they are still where they were when QE2 started. So we think the Fed will probably hold its firepower back. But I have to tell you, market sentiment, if it keeps worsening the way it has, the Fed might be tempted into doing something a little more dramatic.
A little more dramatic, such as QE3, perhaps?
At least signaling that QE3 is likely to come. We don't think the Fed is there yet, but stocks could be down another 5% by the time the Fed meets, and then who knows?
So we're not expecting any movement from the Fed at all, especially on the Fed funds target rate. That's going to stay the same, you think?
Right. We think the Fed will wait for the market to sort this out for itself.
Ajay Rajadhyaksha, Barclays Capital, joining us from his firm's trading floor. Ajay, it's always a pleasure. Thanks so much.
Thank you.